The excitement around AI has pushed overall market valuations to some of the highest levels on record. One way to see this is through Buffett's favorite measure, often called the Buffett Indicator. It measures the total value of the US stock market compared to the GDP. Right now, it sits at above 200%. In simple terms, the market is worth more than twice the size of the entire US economy. If we adjust this chart to show how far it's moved from its historical trend, the picture becomes even clearer. Going back to 1950, there have only been a handful of times when the Buffett Indicator has been this elevated. In 2021, at the height of the dot-com mania in 2000, and in the 1960s. In each of those cases, Buffett preferred to stay cautious, and today, this indicator is right back in that zone. Buffett's caution might also come down to how concentrated the market looks today. Today, the 10 largest companies in the S&P 500 make up almost 40% of the entire market value, an even greater share than during the late 1990s dot-com boom. When so much of the market depends on just a few companies, it can make the market more fragile. Another key metric Buffett watches is something called the earnings yield. It tells us how much a company earns for every dollar invested in its stock. Right now, the S&P 500's earnings yield is around 3.2%. It's lower than the return on cash, with 3-month treasury bills yielding close to 4%. In other words, investors are being paid more to hold cash than to own stocks, a setup that usually means equities are expensive relative to safer assets. The last time this happened was between 1998 and 2000, a period just before the dot-com bubble burst. Of course, not everyone shares Buffett's cautious view. Other prominent investors like Tom Lee and analysts at Goldman Sachs argue that we're not yet in bubble territory. They believe there's still room for markets to climb even at these elevated valuation levels because underlying business fundamentals remain strong and earnings growth continues to justify higher prices. And history also gives their case some weight. Back in 1998, the Federal Reserve decided to cut interest rates to stabilize the economy, and the dot-com rally went on for another 2 years before finally peaking. Lower rates make borrowing cheaper and push investors toward riskier assets like stocks, which often drives markets higher. We could be seeing a similar setup now with the Fed cutting interest rates again, which means markets can stay elevated for longer before Buffett or his successor, Greg Abel, finds the kind of discount they're waiting for.